Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Microsoft.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. And I think the core question we really have to answer for you today is this.
Yeah.
Is Microsoft, just a mature defensive software company? Or has the AI revolution fundamentally restarted its engine?
And turned it into something else.
Exactly. Turning it into, well, the ultimate infrastructure compounder. And the data really does suggest the latter. Strong.
Okay, let's unpack that claim. Because when you look at a company this large, the sheer scale of it often works against high growth rates. They're everywhere.
It's the law of large numbers.
Right.
Yeah.
So how can they possibly still manage top-line acceleration?
That's where the full year 2025 results become so compelling. We're looking at $281.7 billion in revenue, which is massive.
It's a staggering number.
And yet, they're still compounding, growing 15% year over year. But here's the key point. Operating income jumped 17%.
So it's not just growth. It's profitable growth.
They're achieving both. High growth and improving efficiency at the same time.
That efficiency is vital. It means they aren't just, buying growth. They're getting leveraged growth. And looking at the fourth quarter breakdown, intelligent cloud is the obvious headline.
It always is.
Growing 26% to almost $30 billion in a single quarter. That right there is proof the enterprise cloud transition isn't slowing down.
Intelligent cloud is absolutely the principal profit contributor. And it's critical to look inside that segment. Azure, the main driver, it just surpassed $75 billion in annual revenue for the full fiscal year.
$75 billion, and that's just Azure.
That's just Azure. And what's fascinating is sustaining 34% growth year over year at that scale. It signals they are deeply entrenched in the largest enterprise workloads globally.
That sustained 30+% growth is almost unheard of for a business that size. It has to mean they're still gaining market share.
Absolutely. The broader server and cloud services category grew 27%, but the real gas on the fire is Azure and other cloud services. That's up a stellar 39%. That's pure momentum.
And if we connect this momentum to the future, this is where the AI monetization story becomes real. It's not hypothetical anymore.
Not at all. Management has confirmed it. AI revenue is on track to exceed a $10 billion annual run rate.
In the next quarter.
In the next quarter.
A $10 billion business created in, a little over a year. They're calling it the fastest growing business in the company's history.
And the reason it's growing so fast is because they aren't selling a new gadget. They're embedding AI directly across platforms people already use.
Azure, Microsoft 365, Dynamics.
Exactly. It's a core layer, not an optional add-on. And speaking of existing platforms, we can't overlook the high-margin productivity segment.
Right, this is the cash cow.
It's the stable cash flow that funds all the AI ambitions.
Right. Productivity and business processes, so think Office and Teams. That segment still grew 16% overall. Specifically, Microsoft 365 commercial cloud revenue was up 18%.
And that 18% isn't just more users signing up. It's the early adoption of Copilot starting to flow through.
The AI assistant.
The AI assistant. And if you talk to anyone in enterprise IT, the idea of an AI that could save 5, maybe 10 hours of administrative work a week per employee, even if that's only half true, it completely transforms the value proposition of that M365
So people are willing to pay the premium for it.
They are. And even LinkedIn revenue was up 9%. It just proves the B2B advertising moat is still holding up really well. It's just another stable premium revenue stream.
Okay, so we've covered aggressive growth. We've covered the ecosystem strength. Let's talk profitability, especially with the a huge cost of building out for AI.
Right, that CapEx spend. It's enormous. But despite that, the gross margin remained robust, sitting at around 69%. Even better, the operating margin expanded to roughly 49%.
That margin expansion is a stunning feat. I mean, they're funding the most capital-intensive build-out in decades while achieving better operating leverage.
They are funding their own growth from an immense position of profitability.
Which brings up the big question. Can they sustain the CapEx needed to win the AI race? Management has guided that it could reach up to $30 billion for a future year. That is a colossal number.
It is, and it begs the question, are they spending it efficiently?
Exactly. Is there a risk that by throwing so much cash at it, they're just raising the bar for competitors like AWS and Google to catch up?
That's a highly critical point, but their balance sheet gives them the cushion. Microsoft operates with what we call a net cash balance sheet.
And for anyone listening, that just means, what does that mean in simple terms?
It means their cash and liquid investments are significantly higher than their total debt.
Minimal debt, maximum liquidity.
Precisely. This gives them unparalleled financial flexibility. They have the war chest not only to fund that $30 billion capex bill, but also to continue growing free cash flow faster than revenue.
And they're still returning capital to shareholders.
A lot of it. They returned $9.4 billion in Q4 alone through dividends and buybacks. It just shows real discipline, even when they're in this massive growth phase.
Okay, let's transition from that $30 billion investment to the moats they're actually building with it. We know competition is fierce. What makes Microsoft uniquely defensible?
Well, first, just the sheer physical footprint, it's nearly impossible to replicate. They operate over 400 data centers in 70 regions.
That's more than any other cloud provider.
More than anyone. And they're adding over 2 gigawatts of new capacity in a single year. Plus, every single Azure region is now AI first.
But the real moat isn't just the number of buildings, right? It's how everything connects.
It's the interconnected ecosystem.
You mean Windows, M365, Teams, Dynamics?
Exactly. That entire stack creates this deep workflow lock-in for massive enterprises. The switching costs to decouple your email, your collaboration tools, your ERP, and now your AI layer from Microsoft.
Yeah.
They're virtually insurmountable.
So it's not just Azure versus AWS anymore.
No, it's the entire Microsoft stack versus everyone else.
And we're seeing that lock-in accelerate with their new developer platforms like Microsoft Fabric.
Right, their unified data analytics product. That's already at 25,000 paid customers. They are rapidly capturing the data layer, where all the AI models are trained and deployed.
And supporting that is Azure AI Foundry, which gives customers access to over 11,000 models, OpenAI, Meta, Cohere. And the adoption is huge. 80% of the Fortune 500 are using it.
This embeds them so deeply into their customers' most sensitive data workflows.
Yeah.
It just raises the exit barriers significantly.
And if we look at the competition, say Salesforce or ServiceNow, Microsoft is using AI as a disruptive force. They're embedding it directly into existing subscriptions.
That is the game changer. It puts tremendous pressure on peers because Microsoft is essentially offering these AI value adds right where the work is already happening. It makes their price per seat look incredibly attractive.
Okay, let's shift to the counter-argument. Even the best companies face risks. What's the biggest one facing Microsoft right now?
The biggest near-term risk has nothing to do with their execution. It's all about market psychology. We're seeing this AI bubble narrative that has been dragging the Nasdaq lower. The risk is multiple compression.
And for the listener, what exactly does multiple compression mean in practical terms?
It means that even if Microsoft continues to grow profits at a stellar rate, the valuation the market assigns to those profits, the multiple, it shrinks. The share price can fall, not because the company did anything wrong, but because valuation fears trigger a rotation out of tech.
That makes perfect sense. And given the premium valuation Microsoft carries, any small disappointment could trigger that. A slip in Azure growth below the low 30s.
Or slowdown in AI monetization, absolutely. It could trigger short-term downside, but the mitigant here is quality.
The safe haven argument.
Exactly. Microsoft's diversified revenue, its high free cash flow, and that net cash balance sheet, it all positions it as a relative safe haven in tech. When the market panics, quality tends to be sold last and bought back first.
And the technical picture seems to support that. Analysis suggests the stock is trading in a long-term ascending channel, and this recent volatility is just a correction toward key support levels.
Right, around the mid-$400, which many technical analysts see as an attractive long-term entry zone.
So let's focus on near-term catalysts. What should we be watching for?
Management has given very clear guidance. They expect Azure revenue growth in the low 30s for the next quarter, 31 to 32% on a constant currency basis.
So the key catalyst will be the Q2 earnings report, usually late January.
That print will be absolutely critical. We'll be watching two things. First, does Azure growth hit that guidance? And second, does that AI revenue run rate hit or hopefully exceed that $10 billion target?
And the institutional interest seems to suggest that any dip before then is a buying opportunity.
I think so. The sheer scale of the build-out, like that Fairwater data center project, described as delivering 10 times the performance of today's fastest supercomputer. It confirms that this secular AI demand is strong. It's relatively insensitive to short-term macro jitters.
And there's always that speculative optionality. I'm thinking about AI security.
That's a huge one. Governing AI agent permissions across an entire enterprise is a massive, complex new problem.
A problem Microsoft is perfectly positioned to solve and then cross-sell into its existing Untra and Defender products. It's a classic move for them.
It is. It tightens the ecosystem lock-in even further.
So to wrap this all up, Microsoft is a structurally advantaged hyperscaler that has successfully leveraged its existing dominance to seize leadership in the AI race.
Yes. And despite the near-term noise and valuation fears, the AI flywheel is generating double-digit growth and expanding margins. It remains one of the cleanest, highest-quality ways to own this multi-year AI and cloud supercycle.
A truly defensive compounder built for the next decade. So the question you need to consider is whether its proven execution merits the premium it demands, or if that $30 billion spending spree is the move that ensures its long-term victory. Thank you for joining us today for your daily stock analysis. We'll catch you next time. And if you found our discussion useful, please subscribe, like, and comment to support the show.